Good day. Welcome to Q2 and H1 FY2023 earnings conference call of MPS Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rahul Arora, Chairman and Managing Director. Thank you, and over to you, sir.
Thanks, Mike. Good afternoon and welcome to our Q2 FY2023 earnings call. Today I have with me Sunit Malhotra, who you all know is the CFO of MPS Limited, Sukhwant Singh, Chief Delivery Officer, India. Today, Sunit will kick things off in our opening segment by discussing our Q2 FY2023 performance. Then Sukhwant will update us on the content and e-learning business. Finally, I will discuss how the current financial year is shaping up and also provide an update on the recent acquisition of EI Design. Let's get going. Over to you, Sunit.
Thanks, Rahul. We developed impressive momentum in Q2 that also drove significant margin expansion. At INR 125.60 crores, FX-adjusted revenues were up by 13.77% against previous year, primarily driven by three factors. Growth in the content business, particularly in our scholarly customers, including journals and books. Growth in the e-learning business, standalone and in EI Design, and more stability in the platform business. I would like to now hand it over to Sukhwant to discuss the content and e-learning solution performance in Q2 FY23 and overall prospects for the business in FY23.
Thank you, Sunit, and hi everyone. So I'll start with an update on the content solutions business. So our revenues in the content solutions business grew by almost 10% in the Q2 FY23 over the same period last year, and the profit increased by almost 30% during the same period. So a growth of 10% in revenue and 30% in profit. The journals led growth in the content solution business in Q2 of FY23, and given the highly profitable nature of this business, the scale-up also meant that margins also improved for the content solution business as a whole. So the expansion was led by phenomenal growth in business with both our established as well as the new customers. The other part of our content solution business, the books vertical, also did well in Q2 of FY23. The trend towards offshoring continued in our education business, which sort of further helps our margins. Coming on to our e-learning business, the e-learning business significantly grew in Q2 of FY23 due to addition of EI Design and impressive double-digit growth in MPS Interactive and TopSim, which is our German-based entity. The revenue grew from a consistent flow of projects from both our star accounts and also the new customers. The highlight of the growth at TopSim was that it was primarily driven by product revenue enabled via the new TopSim Cloud, which is a high quality of revenue from a financial as well as strategic lens. While our revenues grow, our order book also expanded by over 20% as we booked significant and sizable orders. Our pipeline is robust across different types of work, different geographies, and varied across training strategies. So while margins significantly expanded in e-learning, they have yet to reach their true potential, and we strive to expand this further in Q3 and balance of FY23. Thank you, and back to you, Rahul.
Thanks, Sukhwant. The muted start in Q1 was left behind in the rearview mirror as we gained significant new momentum in Q2. We are well on track to beat our guidance of 100 crores in PAT in FY23 despite the looming recession. As a learning and platform solutions business, various factors give us confidence, including our content business is doing exceptionally well with our scholarly customer base. We were at the early innings of the growth story for this customer base, and growth will continue to unfold the rest of the year. After a steady pickup in Q2, performance will be even more impressive in the content business in the second half of the year. While we reported growth and rich margin expansion in Q2 in the e-learning business, our ambitions are higher and will begin to be unlocked truly in the second half of this financial year. In our third year of ownership, the platform business is finally stabilizing. Given the distressed nature of the Highwire asset and the fact that we acquired it at a competitive purchase price, we saw a massive ROIC during an impressive payback period of less than 3 years. Though true growth will only unfold in the fourth, possibly the fifth year of ownership. To conclude my comments, I am delighted with our continued progress in the integration of EI design into MPS. The experience of acquiring a growth asset at a competitive purchase price is remarkably different from distressed acquisition strategy that previously was held. In fact, the EI operating model has allowed us to scale our most significant e-learning business and direct some of the super creative teams to focus on higher value pursuits and projects. During the week of October 24, we launched a new brand called EI, powered by MPS, which will represent our combined e-learning business. The brand is positioned as an emotionally intelligent experience design company. Our new logo is inspired by Daniel Goleman's 5 pillars of emotional intelligence. We want to leverage the power of human connection and empathy to build resilient, high-performing individuals and teams with more profound engagement with the organization. Understanding the intent and not just the scope is part of our DNA, which helps us connect with learners over and above and beyond training. Our ability to create impact on their lives enables performance, helps drive career growth, and create a belonging that transcends beyond data and analytics, assisting organizations to reinvent the workplace experience. We look forward to your continued support in this exciting new growth phase of MPS of building scale. I would now like to open the call to questions.
Thank you, sir. We will now begin the question and answer session. Participants who wish to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Vaibhav Bhattacharya from Honesty and Integrity. Please go ahead.
Hi. Thanks for providing the question. This is Vaibhav Bhattacharya here. So on the last quarter, you said about the ESOP program that you were exploring for the talent retention. So just wanted an update on that. Have you finalized something, and what is the update on that?
Thank you, Vaibhav, for the thoughtful question. Yes, it's in progress, and we're expecting to close that out this financial year. Of course, it has to go through the nomination remuneration committee and then also approved by the board of directors. So we are following the process.
Okay. So it should be in place by the end of the year, is what you're saying?
Yes, fingers crossed.
Okay, got it. And secondly, there's this merger of Penguin Random House and Simon, which is now getting delayed. So are we in any way associated with these companies, or will we be impacted either positively or negatively due to this development if this merger doesn't go through?
So we are not in the trade segment. Both these publishers that you have mentioned are in trade publishing. Our focus is in learning and education. So we work with within publishing. We work with scholarly publishers and education publishers, includes college and K-12. We do not work with trade publishers, at least not in a significant way. So for us, this has no impact at all.
Okay, understand. Got it. That's it from my side. Thank you.
Thank you.
Thank you. Participants who wish to ask a question may press star and 1 on your touchtone telephone. Participants who wish to ask a question may press star and 1 on your touchtone telephone. We have the next question from the line of Arjun Balakrishnan, an individual investor. Please go ahead.
Yeah, thanks for giving this opportunity, and congratulations for a great set of numbers. My question is on any updates on acquisitions, because we've been talking about big ticket acquisitions. So is there anything in the pipeline this financial year?
Thank you for your question and for your kind support. We, as I shared previously, we are always actively pursuing acquisitions. We have a growth office that is focused on this strategy. At any given point of time, we are examining 10 to 15 different opportunities. Currently, we have about 4 that are active and warm. In terms of when we will close one, that is more forward-looking information and guidance that we do not provide. But yes, acquisitions continue to be very much part of our growth strategy. And out of the 10 to 15 that we're pursuing, 4 are what I would call warm and things that we think will be closed in the foreseeable future. What is that foreseeable future? Time will tell.
Okay, thanks. And one final question was, last quarter, I think there was some kind of delay in one of the projects, if I recollect correctly, in the e-learning business. Is that now back on track, if I remember correctly, and pardon me if I'm wrong?
Yeah, it was more in the education business. It's back on track, but still we have not recognized as revenue in Q2.
Okay, great. Thanks and all the best. And it's great to be part of MPS. Thanks.
Thank you so much.
Thank you. Participants who wish to ask a question may press star and 1 on your touchtone telephone. Participants who wish to ask a question may press star and 1 on your touchtone telephone. We have the next question from the line of Arjun Goyal, an individual investor. Please go ahead.
Hi, sir, and congratulations on a very strong set of numbers. So I had a question. Can you tell me what is the dollar or the constant currency growth rate for the last quarter for Q2, either on a year-on-year basis or on a quarter-on-quarter basis?
We typically track and report the FX adjusted revenue, which is pretty close to the constant currency, and that is 13.77%. As reported, we are at 14.87%.
Okay, so the number to focus on is this FX adjusted revenue.
Yeah, we focus on the FX because the reported, we're obviously getting, fortune favors the brave, we're getting benefits of the depreciation of the rupee, so that's 14.87. Right. But just right. to look at the true growth, it's 13.77.
Okay, thanks. So, on the same subject, that EBITDA has gone from 30 crores to 40 crores over the last year. So, how much of this 10 crores would be because of foreign exchange benefit, and how much would it be, internal efficiencies or things like that? Can you break it down further?
So I'll let the finance folks calculate that really quick. But again, I would encourage you to look at our investor presentation that we upload on our website. What you will see the EBITDA that we are reporting is EBITDA. That EBITDA is on FX adjusted basis, not on reported revenue. So that's true EBITDA. And the reasons for that growth in EBITDA, they're coming primarily from our content business. You'll see our margins have significantly expanded. A large part of that is journals, and our scholarly content business as a proportion of our overall content business has grown. And this is a higher margin business. So whenever journals or scholarly content grows, it tends to outperform all the other aspects of content. And because this is now increasing as a proportion, it's a healthy sign for the margin, from a margin perspective. Additionally, we have also seen an improvement in our e-learning margins. As Sukhwant described at the top of the call, while we are satisfied with the performance, we have still not unlocked our true potential in e-learning, which you will start to see from Q3 onward. So what you're seeing on our investor presentation on the EBITDA margin front is on an FX adjusted revenue. Okay.
So that's actually very, very that's a very good sign, right? I mean, okay. I've understood it correctly. Like, it's because of better, more value-added services versus just a tailwind of dollar appreciating, right?
Yeah, so it's definitely, so there's true operational performance, but then again, there's also that aspect of the rupee depreciating, which has given us additional tailwinds, but not that there was a very, very strong core already available, which is driving everything. I would say roughly if you compare, again, very, very, very ballpark estimates, roughly the difference would be 2 to 3% coming from the currency. Most of it is actually coming from operations funds.
Okay, wonderful. And so you mentioned about e-learning. What do you estimate are your target margins there? I mean, we're saying it's still not up to the mark. So what is the mark?
Our goal, of course, is to get to the industry standard, which is 25%. That's just an average number. So our first milestone is 25%, but of course, MPS normally does better than its competitors. So, till we get to 30%, we will not settle, and we'll continue to pursue margin expansion. So I'm hopeful that we'll get very close to the number this year itself.
Okay, wonderful, and best of luck, sir.
Thank you.
Thank you. Participants who wish to ask a question may press star and 1 on your touchtone telephone. Participants who wish to ask a question may press star and 1 on your touchtone telephone. We have the next question on the line of Jyoti Singh from Orient Capital Markets Limited. Please go ahead.
Thank you for the opportunity and congrats on the good set of numbers. So my question on the segment side, as you did mention that we are not reach what the potential we have. So what are the growth strategy that we are targeting that will helpful to drive more revenue and growth in our business?
So, are you talking across the business or specifically in e-learning?
Across the business.
Yeah. So overall, I think we have a multi-pronged approach. We today across the business, we have almost 600 customers, and our first strategy is to go deeper into each of these customers. We are working, very closely across the business. You'll notice that at the top of the call we spoke about a concept called star accounts. Star accounts are essentially accounts that we've identified that potentially over a period of time should become extremely large customers for MPS. We currently have identified 30 customers in the star account program, which have already begun to scale. So this exercise began about 2 years ago. Our next phase will be to take the 30 to 100. So we will ramp up to now from 30 accounts to 100 accounts, which we will then again, scale and grow. So the first leg of our growth strategy is organic, which is making sure that out of the 600 accounts that we own, 100 of them become star accounts over the next few years. And we've already we've executed 30. Now we're going to be ramping up to the next 70. The second piece of our growth strategy is focused on new capabilities and new development. Every year we are launching new capabilities in partnership with our customers, but also developing products that are either offshoots of existing products and solutions or are combining different parts of the business. So, for example, this past year we've launched 3 initiatives. The first one was, we launched a new version of Mac+, which is an existing platform, which is HTML5 based. The new version is HTML5 based. Another initiative was where we combined the capabilities of our e-learning business and our content business to go after the educational institution market. So that was another go-to-market strategy. And the third is we are building another platform that combines our bench stress product from Highwire and our Ampere product from MPS as a new project called Project Herald. So these are just three examples of many of the things that we're doing to launch new products and new capabilities. The third thing that we're doing actively is going after new logos. And the way we're doing that is we are being very thoughtful and rigorous in terms of our marketing, both offline and online marketing, to drive awareness and interest into the company. And also we have started to scale up our sales team. So we have an account development team that's focused on the 600 customers that I described. But now we're also investing in a hunter/sales team that's going after new logos based on the leads that we're generating from our various campaigns. So just 3 examples of the things that we're doing on the organic side. On the inorganic side, we have transitioned from the strategy of acquiring distressed assets at distressed prices to acquiring growing assets at competitive prices. EI was our first such acquisition. As I described to the gentleman on the previous question, we are actively pursuing 10 to 15 of such type of growth assets, and currently there's about 4 transactions that we're pursuing where we feel optimistic about some form of closure in coming periods.
Okay. And sir, my next question on the margin side, what margin guidance you are targeting coming FY2023-2024, and how much growth we are targeting for the same?
Content, we're happy with the 40% that we're reporting. Beyond this, we would want to drive it through revenue growth. There's significant operating leverage available in the content business. So as revenue grows, margins will continue to expand. With platforms, we would want that to also operate closer to the content margins as well. And on the e-learning side, like I was describing earlier, we want to be at 30%. So 40, 30 is what we would want to strike in the coming year. That's really the goal that we're striving towards.
Okay, thank you, sir.
Thank you. Participants who wish to ask a question may press star and 1 on your touchtone telephone. Participants who wish to ask a question may press star and 1 on your touchtone telephone. We have the next question from the line of Rahul Jain from Dolat Capital. Please go ahead.
Hi to the MPS team. Congratulations on a very strong number. Hope my line is audible.
Yes, Rahul, you're loud and clear.
Yeah. So I have a couple of questions. Firstly, on the new branding that we have done, and any more input you could give in terms of how the clients are seeing this, and also in terms of what exactly you want to position with this new branding. That is question number 1. Second thing, from a profitability point of view, we have seen that from last year, comparison to last year, we are doing more revenue with lesser employee headcount. How sustainable is this? And thirdly, also related question could be sustainability of profitability, because that is driving a much faster earning growth versus revenue growth. So if you could give your thoughts on these 3 aspects. Thank you.
Sure. So the first aspect on the rebranding, we possibly have the widest capability set in the e-learning space. We do everything from learning consulting to learning design to simulations, games, AR, VR. We have a bunch of learning platforms, because we had that the Tata Interactive acquisition that gave us so many capabilities, and then we had EI Design earlier this year. The thought process really behind this rebranding was to help the customers understand that the value that we provide is not are not the products and services, but our ability to solve problems for our customers, and then focus on growing that customer relationship. And then the products and solutions are simply tools that are means to solving those pressing learning and development challenges that our customers are facing. So we're not trying to individually sell products, individually sell services. We instead are solving learning and development challenges that our customers are facing. And these tools and products and services are all the ammunition that we need to enable that problem solving. Why emotional intelligence? We must respect that when a learner goes through a learner journey, when they join an organization or they're upskilling or reskilling within an organization, there's an immense change process the learner is going through. Very often an organization or a vendor partner like MPS focuses on the product, the service, or the solution without and misses the learner context. What our emotional intelligence value proposition is doing here is saying that we will design the learner solutions for you, keeping the context of the learner in mind, as well as keeping the context of the learner's environment. So if I am a new employee and I've joined an organization in the tech space, which has high churn, my context is very different from someone who is in a manufacturing plant, has been with the company for 20 years, and is now trying to learn a new technology. So we optimize for the learner context, both in terms of the individual's context and the environment's context, which ensures that as our customers outsource to us, they know that we are coming at this from a humanist approach versus just trying to sell a product or a service. So focusing more on the value. We launched this at DevLearn, which is one of the biggest learning events in the world, a couple of weeks ago, and we received a great response. This rebranding was not done in isolation. We in fact had an advisory council of our customers that helped us think through the process after the acquisition of EI Design, so customers from both sides. And it was co-branded, not co-branded, but it was inspired through some of our customers. So we believe it represents two things. One, that when learning and development is thinking of outsourcing, they have a partner that they can trust, who will be consultative, creative, and also create magic through their learning. But also the second piece of this is that we will not just think about our organization or our customer's organization, but really about the end learner in mind. So that's on the rebranding piece. In terms of margin expansion, we've always spoken that this business has significant operating leverage. Where MPS is different from some of our other competitors in the marketplace in general is that we invest significantly in developing new workflows, new processes, as well as new technologies to make sure that we continue to be efficient. We are always looking for ways to automate, to do system-based delivery. We have a team based out of Bangalore, headed by our CTO. We have a unit called MPS Lab that focuses entirely on speed and efficiency. There's almost 100 engineers across various roles that are focused on efficiency. These engineers are focused on our internal headcount, not on external platforms. And we've been investing in this now for almost a decade. Some of the returns are compounded now, and we're seeing some of the effects of those returns as customers have also, because of the pandemic, accepted a lot of the innovation and automation that we wanted to introduce. So there's one lever that's coming from doing more smart work rather than grunt work. And of course, the second lever is we tend to operate in tier 2 cities as much as we can. And of course, post-pandemic, that's even been further expanded as we've onboarded talent across India through remote working, even in our e-learning business. So from a sustainability standpoint, as I advise, I think content business, late 30s, early 40s is very sustainable. Platform business, we want to get towards the content business margins, and e-learning, we see a path towards 30% over the near term. And of course, once we get there, we have other plans that will require more effort, but 30% in e-learning is possible.
Right. And if I can give in one more, if you could share your thought in terms of having a very long tail of customers with very, very low revenue per client revenue matrix, how we plan to optimize on this front, either from a mining perspective or eventual pruning, if you intend to do that. And in general, thoughts on growth prospect with macro taking the shape the way it is. Any views on that?
Yeah, so as you would have noticed, customer concentration over the years has significantly reduced. Our top 10 now contribute to less than 50%. You've been following us for a while. you knew that this number was like 80% 5 years ago. And similarly, the top 15, even the top 15 are at 55%. Again, this number was almost 90% 5-6 years ago. So there's been a significant diversification by intent to diversify the customer base, to protect ourselves from any shocks that might happen as a result of the macroeconomic environment. We have a wide net. As I was describing earlier, we do have a star account strategy that is bearing fruit. So we've been, for the last 2 or 3 years, we've been focusing on these 30 customers and we've graduated them to a star account status. We believe we have the infrastructure available and the relationships available to scale this to the next 70 customers. And then, of course, if a macroeconomic situation does present itself, I think at this point, we are quite diversified to absorb any major shocks. But of course, macro eats micro. So we as a management team are quite aware of the environment and are constantly in touch with all our customers. We have very deep relationships with our customers. So if a situation does present itself, based on the cues that we will possibly get faster than anybody else because of the deep relationships that we have with our customers, we will adapt and amend. But as of now, we are not hearing anything except what we see on the news. Customers are not telling us that they will be pulling back the events that we're participating in. We're not seeing, in fact, anything. At Devlin itself, we saw 2x of the participation that we saw prior to the pandemic. So we're not seeing it, but we are aware, and we are watching. But nothing. We don't have any data or evidence just yet that it affects our business, at least not in the next 6 months.
Rahul, just one bit more. The client question was more the other way around, not from the concentration point of view, but trying to understand the cost benefit analysis in terms of a very large number of clients, because if I strip out the top 10 numbers, the average revenue per customer for the rest of the portfolio would be a very small number.
Yeah, we maintain efficiency ratios for all our customers. An efficiency ratio is nothing but total manpower cost divided by net revenue. And we ensure that an efficiency ratio, the target for everybody is 40% of the company for every customer. The red zone is 60%. So as long as every customer engagement is between 40 to 60% of the efficiency ratio, we're green. And we make sure that no customer is above 60%. So we don't have that problem because we're very, very disciplined, and we make sure that every customer contract that we sign is between that 40 to 60% efficiency ratio.
Sorry, I could not get this 40-60. What exactly is this? Sorry.
So what we do is we calculate, for every customer, we calculate the total revenue. So revenue would be, we calculate total net revenue. Net revenue is revenue less outsourcing. So we get the net revenue for the customer. Then we look at the effort and the costs of manpower to be deployed on that customer. That number should be 40%, and our ceiling is 60%. So as long as we are between 40 to 60%, we execute the project. If we are not able to execute the project between 40 to 60, we do not take on the project. So we are highly disciplined. So every single project at MPS operates in this zone of 40 to 60%.
Sure, got it. That was my question.
Thank you.
Thank you. We have the next question from the line of Sachit Motwani from Param Capital. Please go ahead.
Yeah, hi, Rahul. Congrats on great set of numbers. My first question was, in e-learning, excluding EI design, how would have been the sequential growth in Q2?
So as I was advising, in our e-learning business, we have 4 business units, if I can call them business units, for lack of a better word. EI and MPS Interactive, which are the India-based entities, both grew in double digits. Our TopSim entity, which is the German entity, also grew at double digits. Our Swiss entity, which does about 1.5 million Swiss francs annually, had a decline of about 30%.
Okay. But on a console basis, what I'm trying to say, sequentially you would have grown, right?
Comparing year-on-year, so Q2 of this year versus Q2 of last year.
Okay. Second question is, has the full payment for EI Design acquisition done?
I'm sorry, can you repeat that, Sachin?
I'm saying the payment for EI Design for the acquisition, has that been done?
Yes. All payments have been completed. That was completed last quarter, I believe.
Okay. My last question is, how do you classify accounts as star accounts when you talk about these 30 star accounts?
So we look at three very basic factors. What is so a star account can be a star account if it checks two out of these three boxes. Current size is large. Second, future potential is large. Or third, there's a strategic element. So, for example, if the account is an Apple or an Amazon, like it's a blue chip customer. Mm-hmm. As long as a customer checks two out of these three boxes, they qualify to become a star account.
Okay, great. And you have plans, to get into IT services also at some point in time. So, are you still evaluating that?
No, I think so. That was I think that was a thing that we had. In fact, we had an acquisition opportunity that we were pursuing at that point in time. It was very opportunistic. I don't think it was a strategy per se. It was more an opportunity presented itself, and we were kind of flirting with it. But I think we've learned that there's still so much low-hanging fruit in this business, in the content learning, e-learning and platforms business. We want to stay focused for a bit. We're only approaching 70 million in revenue right now. As I shared in Vision 2027, our goal is to 3x that. I think we can 3x to that level just by staying focused. Again, it's not that we will not do acquisitions, but they will all happen in this RAM. I think that was just us getting distracted for a bit right there.
Okay. My last question is, you've been talking about consolidation going on in the content space. Would you be willing to acquire a company in the content space? The only reason I'm asking is because if you do so, then there would be again a concentration risk because you'll be highly dependent on content business then.
Yeah, we would only do it if there is some new capability that we wouldn't do it just for the sake of revenue. Because, post the pandemic, we feel that there's still juice for us, like we're seeing in the scholarly business today, with journals growing. There's still juice for us to grow organically. We've created significant lines of differentiation between us, the competition, and our positioning in the marketplace has now been elevated post the pandemic. We were able to deliver to a much higher level than the marketplace on average. So we feel organically we should be able to grow in content. The only reason we would pursue an acquisition is if there's a capability set that we do not own, and that capability set it will probably be very niche, because from a more general term, we are already fairly end to end. So yes, if it expands capability, but just knowing the market in general, it'll probably be a very niche capability, very, very focused. But yes, there are still opportunities within the value chain that we do not currently own, capabilities that we do not currently own. So it's not like we've got all of content covered from a capability standpoint.
Got it. Thanks a lot, Rahul, and once again, congrats. These are great setup.
Thank you.
Thank you. We have the next question on the line of Vaibhav Bhattacharya from Honesty and Integrity. Please go ahead.
Yeah, thanks for providing the follow-up. So, nearly 1/3 of our revenue is from European or UK clients, and we have seen significant currency movement in that region. So, which actually increases the cost for the customer because their currency is depreciated. Are you seeing that they are trying to renegotiate some of the pricing so that they can reduce the burden because it's quite substantial jump for them? because all the contracts are denominated in USD.
So 34% of our revenue comes from UK, Europe, but 84% of our billing is in USD.
Right.
And this has happened over a period of time. It was, in the 60s, if I remember correctly. No, I think even the customers there, are negotiating mostly in USD. They've transitioned to that because these are global companies. They're not really just European companies. Most of the customers that we work with in Europe, I'm talking about the majority here, not the minority, are customers that are global. Elsevier, for example, is a global publisher that's all over the world. Finger Nature is again a global publisher. So their standard is US dollars. That's how they've been run. And we don't see any changes there, and we're not hearing anything from our customers about any changes. In terms of price, we tend, on the content side, we tend to be price warriors anyway. We don't tend to win customers on price. We definitely tend to close customers on price, if that makes sense, on the content side. On the platform side as well, we're middle of the pack, and then on the e-learning side as well, we're middle of the pack. So we aren't sort of the most expensive, vendor out there. So we don't have those kind of pricing negotiations with our customers that others would.
Okay, got it. Understood. Thank you. That's it from my side.
Thank you.
Thank you. We have the next question from the line of Arjun Goyal, an individual investor. Please go ahead.
Hi, sir. Just a follow-up. I have a question regarding the industry structure on the content side and actually more on the scientific journal side. So I was reading this statistic that I think Elsevier and like the top 4 or 5 global publishers account for like 40 or 50% of all the scientific journal or scientific papers published, right, in any given year. So I wanted to know basically, and I believe this number is only growing larger, right? It's consolidating. So I wanted to know, where does MPS sort of fit on the content side in this structure? Because do we target these top 5 players and try to grow their accounts, or are we catering more towards the smaller universities and things like that? If you can just throw some color, that'd be helpful.
First, let me drop. So I always explain, because our industry is very, very niche, and most people don't follow our industry. So let me draw parallels with another industry so that you and others on the call get where we're coming from. So if we look at let's look at video-based content. So today you have a Netflix, Prime Video, a Hotstar, a Disney, etc., driving content, and we're all accessing content through subscriptions. The Elseviers and the Wileys and Finger Nature of the world are essentially the Netflix and the Amazon Prime and the Hotstar and the Disney. What MPS is doing is we are producing content that gets delivered through these companies. So as long as more content is created in the world, irrespective of the channels that deliver the content, MPS will be successful. Does that make sense? So what we are doing is we are kind of one step behind the value chain. We are the producers of the content, and then all of the names that you described on the scientific journal side, they are sort of the distributors of the content. So for us, the market will consolidate. The market could get even more diversified. But what we're confident about is that 5 years from now, there'll be more content in the world. And as long as there's more content in the world 5 years from now, we will be successful.
But in this scenario, right, don't the Elseviers get bargaining power because they are consolidating? Do they try? I mean, how do they try squeezing the likes of MPS?
So the question is, how does a Netflix or a Prime Video or a Disney differentiate themselves? They differentiate themselves through new, fresh content that beats the competition. So the pressure is not on price, the pressure is on differentiation. So they need to work with vendor partners that can enable that differentiation.
Right.
The pressure is more on the quality. The pressure is more on the speed of the product.
Right. Thanks. That's very insightful. Thank you.
Thank you.
Thank you. Participants who wish to ask a question may press star and one on your touch-tone telephone. Participants who wish to ask a question may press star and one on your touch-tone telephone. We have the next question on the line of Keshav Garje from CKIPL. Please go ahead.
Sir, thank you for providing me this opportunity, and I wanted to congratulate you for all-time high profits this last quarter, and we hope that the company stays on the growth trajectory. So since you mentioned in the call after EI Design acquisition that we should be expecting at least one more acquisition in this financial year. So now with the...
I didn't say that. I did not say that. I said that we are working on many acquisitions. 4 out of them are warm/hard. We can expect an acquisition in subsequent periods. I did not say that it would happen this year. I don't know. It might happen, but I did not confirm that it will happen.
Okay, sir. I stand corrected. So, but in any case, since we are looking out for acquisitions, and sir, with the recessionary trends in Western countries and the sentiment at rock bottom, so are you seeing the asking price for these acquisitions becoming more sensible and more lucrative for us?
It's definitely a buyer's market. I wouldn't say that the asking price has gone down because companies will obviously ask for a higher price, but I think transactions are getting executed at lower. We are seeing transactions get executed at lower multiples. It seems like, at least I can only speak for our space, it seems like we're getting into a world of a buyer market. We are seeing, and I don't know what the reason for this is, but we're seeing a lot more volume in terms of inflow of deal possibilities. Now, I'm not a finance expert, but I would normally think that if the market is dry, then you'd have fewer opportunities. But for some reason, we are seeing a much heavier volume of inflow of possible deals than we ever have in the last 5 years. And in terms of do we think it's a buyer's market? We do feel it's a buyer's market because we are seeing transactions happen at much lower multiples given the growth of the business. And EI is a good example, right? We bought them at less than 3.5 times of EBITDA, and it's a company north of 20% EBITDA margin and growing at 15-16%. So we have executed one this year itself.
Sure, sir. Sir, also wanted to understand that I joined this call a bit late, so I hope I'm not repeating myself, sir. But this platform division, so you think that this financial year will be the last year of contraction, and from next financial year, even this division will start growing?
Yeah. So this was our last acquisition of a distressed asset. We've done now 7 distressed asset acquisitions before EI. And our experience, we've seen that it takes 5 years to, on average, across the 7 that we've done, across the 6 before Highwire we've done, for an acquisition to start to really perform. The first year for us is about stopping the bleeding and making sure that we're cash positive. The second year is more about getting the customers satisfied and the employees satisfied. The third year, the customers and employees tend to get more optimistic about the future, and we start to see some growth in the 4th year, and in the 5th year things really start to take off. We've just started our 3rd year in Highwire, and we have to see how the cycle performs out, but that's typically been our experience, and Highwire is part of the course. In fact, perhaps slightly ahead in the rest because Highwire was profitable from the first month. But other than from a growth perspective, I think it's going to follow that 4-5 year cycle that we've seen.
Okay, so thank you. Okay, so thank you very much and best of luck.
Thank you.
Thank you. We have the next question from the line of Mahesh from RIA. Please go ahead.
Hi. What would be the size of the 4 opportunities that you're pursuing in e-learning?
We are not looking at anything less than $10 million in revenue.
So would that be bigger than AI design?
Yes, of course. AI was much smaller. And we are not looking at anything less than $10 million in revenue annually.
Okay.
And we're not looking at anything that's declining. We're looking at businesses that are growing, businesses that are north of $10 million in annual revenue, and businesses that are profitable.
Are they based out of India?
Sorry?
Are these opportunities companies based out of India?
Both. We're looking at India-based and international opportunities. Both.
Okay. Thank you very much.
Thank you.
Thank you. Participants who wish to ask a question may press star and 1 on your touchtone telephone. As there are no further questions, I would now like to hand the conference over to Mr. Rahul Arora for closing comments.
Thank you, everyone. Like I said, Q2 was a strong recovery after a muted Q1. We continue to support our guidance from the first quarter that we will beat 100 crores in profit after tax in FY23. I'm told by many experts on the finance side that it is a magical moment when a company crosses that level, especially with a diversified customer mix, new opportunities get unlocked, newer plays open up. So we are hopeful that once we achieve the level of scale, new opportunities will open up for us as well. Thank you for all your support over the years. This has been a very long journey, and I think we're starting to see that MPS is now moving from being a small mid-sized company to a company that is seriously contemplating scale. So thank you for all your support and all your great questions that keep us honest and humble. And again, thank you everyone, and catch you on the next call.
Thank you. On behalf of MPS Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.